What you are witnessing today is not a policy error, a temporary fluctuation, or a lapse in judgment by central bankers. It is the final scripted act of a mathematical cycle that has governed the rise and fall of civilizations for centuries. We are currently trapped in the interest rate conflict, a systemic collision where the Federal Reserve's attempt to control inflation has run headfirst into a 100 trillion global debt wall that can no longer be serviced. To understand this, you must look past the headlines and see the machine for what it is. In the last 12 months alone, the United States has added over $2 trillion to its national debt, while the interest expense on that debt has officially surpassed $1 trillion annually. This means the US government now spends more money just to stay in its current position than it spends on its entire national defense. This is the interest trap, and it is mathematically inescapable. Every time the Federal Reserve raises rates to fight inflation, they increase the cost of servicing this debt, effectively accelerating the bankruptcy of the system they are trying to save. If they lower rates to save the economy, they ignite a hyperinflationary fire that destroys the currency. This is not a choice, it is a checkmate. To see the future, you must understand the four-stage mechanism of systemic collapse. Every empire that has attempted to manage a fiat currency has followed this exact path. Stage 1 is the foundation of suppression, where interest rates are kept artificially low to encourage borrowing and expansion. This creates a false sense of prosperity and allows debt to grow far beyond the productive capacity of the economy. Stage 2 is the period of debasement and overextension. This is when the money supply is increased exponentially to keep the expansion alive, leading to the speculative manias we see today, where assets like silver hit record highs of 67 an ounce in gold. History provides the proof that this pattern is unchangeable. Look at the Weimar Republic in the early 1920s. They followed stage 1 and 2 perfectly, printing marks, to pay for war debts and social programs. When the friction point of 1923 arrived, they chose to print faster to meet their obligations, leading to stage 4, a total currency collapse where a loaf of bread cost billions of marks. Walk through the Nixon Shock of 1971, the US reached a friction point where it could no longer honor its gold obligations. Instead of fixing the system, they moved to a pure fiat standard. Stage 2, expansion on a global scale. Now, 50 years later, we have reached the final friction point of that same cycle. Consider the Roman Empire's debasement of the denarius. As their debt and military costs grew, they slowly reduced the silver content of their coins. Stage 1, expansion. Stage 2, debasement. Stage 3, the inability to pay the military. Stage 4, the total collapse of the Roman economy. The names change, the technology changes, but the math of the machine remains the same. Apply this pattern to the present. The Federal Reserve kept rates at near zero for over a decade. Check. They increased the M2 money supply by 40% in a single 2-year period. Verified. They are now facing a bond market that is rebelling, with yields rising despite the Fed's attempts to signal cuts. Undeniable. We are seeing the final blow-off top in precious metals, with silver reaching all-time highs as the smart money exits the burning building of the US dollar. Check. The Federal Reserve and the Treasury are now in an open conflict. The Treasury needs low rates to fund the government, but the Fed needs high rates to stop the currency from dying. Verified. This is a system in its final stages of failure. The warning is clear. Do not be lulled into the belief that this time is different because of American exceptionalism or modern economic theories like MMT. Math does not care about your optimism. When the interest on the debt exceeds the ability to pay, the system must break. Technology will not save a currency that is being systematically devalued by 7% to 10% a year in real terms. The takeaway for you is simple. Understand the machine. Position yourself in assets that the government cannot print. Gold, silver, and hard commodities. Do not be the one holding the bag when stage 4 reaches its conclusion. The machine was built to extract wealth. Your only defense is to step outside of it. The mechanical reality we are forced to confront is that every modern financial institution is built upon a foundation of compounding debt that has now exceeded the natural growth rate of the human species. When the Federal Reserve and the global bond market enter a state of open conflict, it signifies the death of the illusion of control. We are not merely looking at a bad quarter or a difficult fiscal year. We are looking at the terminal phase of a debt supercycle that began in 1944 at Bretton Woods and was accelerated into high gear in 1971. In December 2025, the signal is flashing red. For the first time in history, the cost of maintaining the past, the interest on existing debt, has become more expensive than the cost of building the future. This is the mathematical definition of a trap. Stage 1 of the pattern, the foundation of suppression, is the most deceptive period of the machine's life cycle. During this phase, which we experienced from 2008 to 2021, the system appeared to have conquered the laws of physics. Interest rates were held at historic lows, often negative in real terms, effectively punishing savers and rewarding those who took on massive leverage. This created a generation of zombie corporations and a housing market that decoupled from median income levels. The Fed's balance sheet expanded from $800 billion to nearly $9 trillion, an injection of liquidity that the system treated as a permanent feature rather than a temporary emergency measure. This stage is necessary to hook the entire global population into the debt system. When capital is free, the incentive to be productive vanishes, replaced by the incentive to speculate. Check. Stage 2, the expansion and debasement, is where the consequences of Stage 1 begin to manifest as a visible cancer. We saw this clearly as we moved into 2024 and 2025. The surplus of printed money finally hit the real-world supply chain, causing the cost of basic necessities, food, energy, and shelter, to skyrocket. To hide the true extent of this debasement, the metrics for calculating inflation were altered, yet the lived experience of the citizen remained undeniable. This is the period where the billionaire class begins quietly rotating out of paper assets and into what we call weird assets, or hard commodities. This explains why silver has reached a record $67.38 and why gold has shattered the $4,300 ceiling. These are not just rising prices. They are a mathematical reflection of the falling value of the currency in which they are denominated. Verified. We have now entered Stage 3, the friction point. This is the most dangerous moment in the cycle because the Fed's tools have become self-destructive. In late 2025, as we see in current data, the Federal Reserve is trapped. If they keep interest rates high to suppress the inflation they created in Stage 2, they cause a sovereign debt crisis. At 4% interest, the US government cannot afford its $36 trillion debt without cutting essential services or printing more money to pay the interest, which, ironically, creates more inflation. If they lower rates to 0% to save the government from bankruptcy, they invite a total currency collapse as the dollar is flooded into a market that no longer trusts its value. This is the friction between the central bank and the bond market. The bond market is now demanding higher yields to compensate for the risk of inflation, regardless of what the Fed says at its meetings. Undeniable. To prove the inevitability of this friction, look at the collapse of the French assignat during the French Revolution. It followed the 4 stages with terrifying precision. Stage 1. The revolutionary government issued the assignat, backed by confiscated lands to provide liquidity. Stage 2. The government, needing more money for war and bread, overissued the notes until they were worth only a fraction of their face value. Stage 3. The friction point arrived when the public realized the math didn't add up. The government tried to force the currency S-value through, law of the maximum price controls. Stage 4. The currency became so worthless it was used as wallpaper, leading to a total reset under a new military regime. The pattern held. The British Empire faced a similar mechanism after the Napoleonic Wars. They were saddled with a debt-to-GDP ratio of over 200%. They spent the next century in a brutal Stage 3 friction point, enforcing austerity and global expansion just to service the interest on their debt. They only survived as long as they did by being the world's reserve currency in the center of the Industrial Revolution. The United States today has the debt of the post-Napoleonic British, but lacks the industrial dominance, as manufacturing has been exported to the East. The friction point is therefore more volatile, and the time frame for collapse is significantly shorter. Check. Consider the 1970s stagflation crisis in the United States as a precursor. The system reached a friction point after the guns and butter spending of the 1960s. The solution then was Paul Volcker raising rates to 20%. That worked in 1980 because the national debt was only $900 billion. Today, with debt at $36 trillion, a 20% interest rate would require $7.2 trillion in interest payments alone, nearly double the entire annual tax revenue of the United States. The Volcker solution is mathematically impossible in the current system. This confirms that we are not in a repeat of the 1970s. We are in the terminal phase of the 1944 cycle. Verified. The systemic application to our current reality is chilling. We see the Federal Reserve attempting to navigate a soft landing, but the data shows a different story. The manufacturing sector is in contraction. Consumer credit card debt has hit an all-time high of $1.1 trillion, and the average American is now spending 40% of their income on debt servicing and housing. This is a system that can never be escaped through traditional means. The Federal Reserve and the Treasury are currently in an interest rate conflict because their goals are now diametrically opposed. The Fed must protect the dollar's credibility, while the Treasury must ensure the government doesn't default. These two outcomes cannot happen simultaneously. One must be sacrificed. In the final stage 4, the systemic reset, the invisible tax of inflation, becomes a visible theft. This is the stage where the public finally understands that the system was never designed to make them wealthy. It was designed to keep them in a state of perpetual labor to service a debt they never signed for. The 2026 outlook suggests that as interest rates remain elevated, the stress on the banking system will cause another wave of failures, necessitating a central bank digital currency, or a drastic devaluation of the dollar to wipe the slate clean. This is the outcome of the machine's math. Check. Dismiss the notion that technology or AI will produce enough productivity to grow out of the debt. While AI is a transformative tool, it cannot create the physical resources needed to pay off $2 quadrillion in global unfunded liabilities. American exceptionalism is a sentiment, not a balance sheet. The laws of mathematics are universal and do not recognize borders. When the friction point is reached, the machine resets. The only way to survive the coming stage 4 is to remove yourself from the machine's path. This means diversifying out of the systemic trap of pure fiat and into the hard money assets that have survived every stage 4 reset in history. The machine is currently in its most volatile state. The conflict between the Fed and interest rates is the death rattle of the current era. You must understand that the coming volatility is not a bug. It is the final feature of a system that has run out of time. Do not wait for the mainstream media to tell you the reset has begun. By the time they announce it, the window to exit will be closed. The mechanical reality of the sovereign debt jubilee is the final ghost in the machine that most economists refuse to name, yet it remains the only mathematical exit for a system buried under $100 trillion of global obligations. As we navigate the friction of late 2025, the concept of the Great Reset transitions from a fringe theory into a structural necessity. To understand why this is coming, one must understand the nature of the digital trap. For decades, the system operated on the friction of physical currency and delayed settlements. Today, the speed of capital has reached near instantaneous levels, meaning that when the loss of confidence occurs in stage 3, the transition to stage 4 will happen not over years, but over hours. The Federal Reserve and the Treasury are currently building the infrastructure for a controlled demolition of the $8s current form. This is why the push for central bank digital currencies, CBDCs, has reached a fever pitch. By digitizing the very nature of money, the system gains the ability to implement negative interest rates directly on your savings, effectively forcing you to spend or lose your wealth to stimulate a dying machine. This is the ultimate system you can never escape. Check. The transition to a digital reset is the modern equivalent of the 1934 Gold Reserve Act, where the government effectively confiscated the wealth of the citizenry to recapitalize the banking system. In the 2026 outlook, this manifests as a currency peg, or a revaluation where the old, debt-laden dollar is exchanged for a new digital token at a significant loss of purchasing power. The news of silver hitting record highs and the massive accumulation of gold by central banks in the East, specifically the BRICS nations, is the smoke before the fire. These nations are preparing for a post-dollar world where hard assets are the only valid collateral left. The Federal Reserve OS conflict with interest rates is simply a stalling tactic to allow the inner circle to position themselves before the floor falls out. Verified. Consider the historical case of the Dutch East India Company and the collapse of the Dutch financial hegemony in the late 18th century. They followed the pattern with eerie precision. Stage 1, the creation of a global trade monopoly funded by the first modern stock market and low-interest credit. Stage 2, the overextension of their military and administrative reach, funded by debasing the quality of their trade goods and taking on unsustainable debt. Stage 3, the friction point arrived when the Fourth Anglo-Dutch War made the debt unserviceable. The Dutch central bank, the Bank of Amsterdam, tried to keep the system afloat by giving emergency loans to the company, the 18th century version of quantitative easing. Stage 4, the public realized the bank had no silver left to back its receipts. The system collapsed, and the global reserve currency status shifted to London. The machine does not care about your flag, it only cares about the ledger, undeniable. We must also examine the systemic destruction of the middle class as a prerequisite for the Stage 4 reset. In every historical cycle, the debt trap is used to consolidate resources. As interest rates stay higher for longer, the cost of small business loans and mortgages becomes prohibitive. We see this in the 2025 data. As the Fed refuses to aggressively cut rates to the levels the market demands, small to medium enterprises are being liquidated, only to be bought at pennies on the dollar by massive private equity firms with direct lines of credit to the central bank. This is the Cantillon effect in its final, most predatory form. The closer you are to the printing press, the more wealth you can extract during the friction point. And the further away you are, the retail investor, the saver, the pensioner, the more you are sacrificed to pay for the system's survival. Check. The digital reset is not just about money, it is about the total surveillance of the economic machine. In the coming Stage 4, the system will attempt to solve the velocity problem of money by putting expiration dates on your currency or restricting where it can be spent. This is the social credit system hidden inside a monetary policy. If the machine can control your ability to transact, it can prevent the bank runs that historically ended Stage 3. However, math dictates that even a total control system cannot stop the devaluation of the unit of account. Whether the dollar is paper or a digital line of code, if the debt grows faster than the energy output of the civilization, the currency must die. Verified. Dismiss the idea that the petrodollar reset can be managed peacefully. History shows that when the reserve currency holder reaches the Stage 3 friction point, they often resort to externalization of conflict. This is why we see the tension in Ukraine and the escalating warnings from US intelligence regarding Putin's long-term goals. War is the ultimate excuse for a debt jubilee. It allows the government to declare an emergency, implement capital controls, and print unlimited amounts of money under the guise of national survival. It is the Great Reset's preferred delivery mechanism. Undeniable. The systematic application to your personal portfolio must be cold and calculated. If you are holding paper promises, stocks, bonds, and bank deposits, you are a creditor to a bankrupt machine. In the final act of Stage 3, creditors are always the ones who take the haircut. This is why the record spike in gold to 40,243 and silver to 6710 is so significant. The market is sniffing out the reset. It is the sound of the exit door being crowded. The interest rate conflict is the final warning bell. When the Fed can no longer lower rates because of inflation, and the Treasury can no longer afford high rates because of debt, the only variable left to move is the price of the currency itself. It must go to zero against hard assets. Check. This leads us to the conclusion of the pattern. We are standing at the precipice of a transformation that happens once every 80 to 100 years. The system you were born into, the world of endless growth, easy credit, and the American dream funded by debt, is reaching its mathematical limit. The Federal Reserve is not your friend. It is the architect of the very machine that is now consuming your purchasing power. The interest rate conflict is not a mistake. It is the inevitable friction of a closing cycle. Final warning, the pattern is absolute. The laws of history and mathematics are not suggestions. We have seen the foundation of suppression, we have lived through the expansion and debasement, and we are now witnessing the friction point in real time. Stage 4 is the only step remaining. Do not be lulled into a false sense of security by modern economic optimism, or the belief that the system is too big to fail. Historically, the bigger the system, the more violent the reset. The idea that technology will save us ignores the fact that technology requires stable capital to function. Without a stable medium of exchange, the complexity of our civilization begins to unravel. Actionable insight. Position yourself outside the machine. Understand that wealth is not a number on a screen provided by a bank. Wealth is the ownership of productive land, precious metals, and the skills required to navigate a post-Fiat world. The systemic revelation is that the machine was never meant to last forever. It was designed to extract, and it is now in its final extraction phase. Don't be the fuel for the machine's final fire. Understand the machine, secure your family, prepare for the reset. If you want to understand how the machine was built and how to survive the specific mechanics of the coming Stage 4 collapse, you must look deeper into the history of central banking and the hidden tax of inflation. Watch our next analysis, where we break down the exact day-by-day sequence of a currency revaluation and how to ensure your assets are protected before the digital trap closes forever. Subscribe and stay tuned to the machine's final movements. The next stage of the pattern has already begun.